Broadcasting live from the IRSMedic studios, it's Parental Advisory. And thanks for joining us on Parental Advisory. Today, I'm sure everyone's sitting around in their turkey-induced coma, so it's a good time to teach them about IRS audits.
Or they're watching it on a replay at any time of their life. That's right.
Specifically, high-income audits is what we're touching on today, because you found that it seems to be the IRS has moved from making sure people are compliant to more of a IRS is making a profit. Well, making money.
Well, it's all a profit, I guess,
yeah, I
right?
guess it really is. So,
well,
you can't see us, but we look damn good
Yeah, I know.
today.
We do look great today.
Okay, so this is what we found out. The IRS currently has fewer staff. We know about that because John Koskinen,
That's right.
he is always whining about his short staff. I didn't mean that. And I would never have thought of that if you didn't laugh, you filthy, filthy person. The IRS is currently short-staffed. So not only are they short-staffed, now I'm going to say it a lot, they have more responsibilities. They're in charge of the Affordable Care Act and also FATCA. So more responsibilities, less
Two of
people.
the most popular laws ever, the Affordable Care Act and FATCA. And that was the conversation around the table, the Thanksgiving table yesterday as everyone was going up. Like, what do I do about this whole Obamacare? Do I really have to sign up? Do I really need to do it? And I was saying, I was like, well, hopefully it will all be repealed. It was really that's the best thing because, it's really the people who are not dead broke, who are self-employed, are the people, and young, are the people who can't afford it.
Right.
And they're the ones who will be penalized. And so then I'm like, well, the penalty will only be able to intercept your refunds. So just make sure you don't have a refund.
It's the only time you don't want a refund.
Yeah.
So the number of full-time staff at the IRS has decreased by nearly 9% from 2010 to 2013, yet they've somehow managed to still collect record revenues. They, total dollars received was, $3.1 trillion in fiscal year 2014. It's a 6.8% increase. So less people, more money. They're saying that the IRS is targeting high-income earners, and that's how they're getting this record revenue. Now, I was surprised they identify high-income taxpayers as those who report a positive income of between $200,000 and $399,000. I don't know why I was surprised that that's high income.
Yeah, and I it was strange to me. Then I started thinking about something, and I was like, this is so weird that you're claiming you want to audit high-income taxpayers, but here's the problem. You want to audit people who aren't reporting their income.
That's a really good point.
So why would you go to the person who's reporting high income? Because maybe that's the person that actually is reporting all of their income. So what you want to go for is the person who's like, I lost $20,000 this year, or I lost $300,000 a year. So it's a very strange metric about who you want to audit. So that is sort of strange because you could actually, I guess maybe there is a legitimate reason for between $200,000 and $399,000 because a person isn't reporting all their income.
Maybe.
It's very odd.
Yeah, I had a hard time wrapping my head around a lot of this.
Right, and that's not necessarily high income.
Right. Not like I'm a rich person, but yeah, but then, I realized I was trying to make sense out of the IRS.
There you go.
That's when I realized the light bulb went off.
There's your problem.
Here's my problem. Now, what you found and I thought was pretty interesting is the Treasury Inspector General for Tax Administration released trends in compliance activities through fiscal year 2014. A very long report.
And their titles are always juicy.
Yeah.
I mean, who? I mean, when I saw that, I was, of course, I couldn't wait. They always have the very long titles.
Yeah, I can't wait to click on this and read it. 500 pages of nonsense.
Well, I always do. I
know.
mean, it's like you call it anything. I mean, that's the thing. They can call it anything they want. It's like, well, I am going to read it.
Yeah.
Because we like to see what's going on. And the Treasury Inspector General is usually full of great things that the IRS completely agrees with, then ignores.
Right.
The IRS agrees with your recommendations. Yes, we agree. We're not going to do any of thing.
Because they are an agency dedicated solely to looking into IRS oversights. Wow.
Yeah.
I didn't even know they existed.
Yeah.
And some of the things that they've done have been pretty positive. That was, the feeling I got is it's a positive agency. They found the IRS was failing to do all it could to protect and prevent business identity theft. They found that channels for sharing sensitive taxpayer information weren't always secure. They monitor IRS scams. So they are watching the IRS, but like you said, the IRS goes, "Oh, that's great. Thanks for sharing that."
But we don't have the budget, right?
We're short.
We'd love to do it, but we're missing the budget. We're so short-staffed.
So it's like they're well-intentioned, but they've got no teeth.
Yeah, there's nothing they can do to make them do anything. I think maybe I don't even know if they could sue the IRS. I'm not even sure they have.
Can you sue the IRS?
Congress has sued the IRS, I think, and then people know you can sue the IRS, or you sue the Commissioner of Revenue is more particular.
Yep, that'd be fun.
Good luck.
Just to see.
Yeah.
Okay, so this particular report for fiscal year 2014 recommended several changes. And this is what surprised me, seeing as so far the agency has been pretty level-headed and made good recommendations. So what they said is the IRS should consider changing income thresholds and what the agency considers high income so as to ensure the efficient use of the agency's examination resources. Here's some quotes from the report. The impact on taxpayers. High-income taxpayers are frequently involved in complex entities and financial arrangements that provide greater opportunities for aggressive tax planning. It's important for the IRS to demonstrate that it enforces tax laws by ensuring that its compliance strategies are applied fairly to all segments of the taxpayer population. What?
Yeah. All right. Well.
So high-income taxpayers, we need to look at them more.
Right. But this is what sort of infuriates me. The part that absolutely infuriates me here this part. It is important that for the IRS to demonstrate that it enforces tax laws by ensuring that its compliance strategies are applied fairly to all segments of the taxpayer population. That is complete nonsense. That is complete, utter nonsense.
You wanted to say bull.
I did.
You really wanted to say it.
Then we'd just have to go back and edit it, and that's the exact opposite of the way the tax code is. The tax code, the cost of compliance are borne on a select few. The real cost of compliance. The regular W-2 earners with your Schedule A, look, your cost of compliance is nothing compared to the people with with foreign entities, with many structures with self-employed. You have no concept of what they have to go through. It is not fair. It is not fair at all. And there's segments of the population that do whatever the hell they want to do, and the IRS doesn't do a damn thing about it. The amount of fraud, the amount of fraudulent tax credits claimed is stomach turning, and the IRS doesn't prosecute any of those people. Mm-hmm. They don't. What they do, if you're running a ring, and you're running a ring for massive amount, yeah, they'll prosecute you. But as far as an individual claiming a phony earned income credit, coming up with all these phony things, the worst that's happened is they don't give you it. Mm-hmm. But they're not going to come audit you. They're just saying, no, we don't think you're entitled to it. Chances are you'll probably get it. You'll get the money, and there's no one looking at it because guess what? There's not really a lot of money to get, and all it does is publicize the fact that, hey, guess what? Right. The IRS is giving away the store. Yeah, while they're talking about this big game about tax compliance, and hey, people need to do a fair share, what if taxpayers really knew what went on? What if the people who are paying knew, like, wait a second, is that easy to rip off the government? Yeah, it is.
Hello, revolt.
Right, and just basically, and they don't have anything to sue after, and they're just not great, juicy targets. They're not all that interesting. And again, they'll certainly qualify for a federal public defender, as we discussed the other day. Even high income earners do. It's funny how it works.
But this is what I found interesting. So, okay, on one hand, they're saying that they should be, the compliance strategies should be applied fairly to everyone. The next thing they said in the report is the IRS should really evaluate whether the threshold for its high income and high wealth strategy set at $200,000 is efficient enough. So wait a second, you want everyone to be treated fairly, then why do you even have thresholds of what should be looked at?
Whoa. Hey, yeah. You're lying, I would say. There you go.
Okay.
There's the answer.
Yeah. So this is why they made all these statements. So they found that every hour spent auditing a taxpayer with more than $5 million in income nets the government about $4,500. If they audit a taxpayer in the $200,000 to $399,000 tax bracket, it generates only $605 in revenue per audit hour. So they now want to say, you know what? Let's forget about these 200 to 399,000 people and look at 5 million and higher because they bring in, a lot more money per hour. So how is any of this fair? How is any of this sensical? And yes, you're going after people who claim they made $5 million. Are they really the ones that are going to be screwing the government? They probably are the ones with the tax lawyers that are helping them prepare everything they need to do.
Well, not necessarily. There's a remarkable amount of people who make a high income who prepare their own returns.
Seriously?
Oh yeah, I've seen it. Oh yeah.
No
yeah, you'd be
way.
surprised. Yeah. Yeah, there's definitely people who make well over $1 million who prepare their own return. And I've seen them on TurboTax.
Really?
Wow. It's like, wow, that's really bold of you. And they tend to be a lot of engineers, a lot of doctors.
Oh, okay.
They're brilliant people and they're brilliant and a lot of things. And you're looking at their returns, you're like, yeah, they're pretty good.
Oh, no kidding.
Yeah. Oh, yeah. No, you see them. They can follow dense language and follow it along.
Yeah, that's true.
I mean, sometimes they miss some things. And sometimes, and this is what happens, is these people, like the worst thing is that these people are like, well, I know I report all of my income. And they're making millions of dollars. They prepared their own return on TurboTax, and they're thinking, well, I did this myself, so I don't have any questions. I can handle the IRS.
Mm-hmm. Oh.
And then the idea that, well, if I hire a tax attorney, that's what guilty people do.
Oh, okay.
And so they go ahead and charge ahead, like, oh, I can handle the IRS. And and a lot of them work with government compliance, another, maybe they work with the FDA or FCC or something. Like, well, I know how to work with the government. And they generally do. And they know that specialty. But the IRS is a little bit different than other places. And I mean, this is an interesting trend that's going on.
Yeah.
You have to understand, Claudine, this is completely different than what it used to be before, because the IRS was always saying everyone has to do their fair share.
Mm-hmm.
I mean, some people have to pay a lot more and some people will give them money. But now this language is frightening to me, because I had my suspicions that they were doing this based on what I've seen. Mm-hmm. And now here it is in writing saying, yeah, we want our audits to generate not compliance, but revenue for that taxpayer. Mm-hmm. The load was supposed to be evenly spread around, so everybody sort of was operating under the same amount of fear. But now, you could really now, there's not a lot of people who make that $1 million over. There's not a lot of them, so they could easily target everybody and say, okay, well, here's the numbers. And now you could see they're going to look at this report, and the examiners are going to get these marching orders. Well, the average is that per audit hour, you should be able to come up with $4,500. So okay, here's your objective. That's changing. Mm-hmm. It was never about revenue. It was about compliance. That's what it's about. But this focus is completely on revenue. Mm-hmm. And it's just so different than things used to be.
And coming from the watchdog.
Right.
These are the people that are supposed to be looking out for us.
Right.
Going,
how did it's like, did someone from the IRS hack into the...
They did.
Or they wrote the report right there. Hey, we wrote a great report for you. We know you guys are short-staffed, so we wrote a great report for you. This is just amazing. This is completely different than what it used to be.
Yep. Now, there's people that are going to be particularly worried about this, I think, and it's a lot of offshore investors, which we've touched on. Yep. But right after the break, we'll touch a little more on how the high income audits may be affecting these offshore investors. Right after this on Parental Advisory. Anthony, tell me about your recurring nightmare.
It's that nightmare where you're yelling, but no words are coming out of your mouth.
I have a similar nightmare where I'm in an emergency, I need to dial 911, and my phone won't work.
That sounds terrifying.
It is. And I think I know why we have these dreams.
Why is that?
The problem with the IRS isn't just the IRS. The problem is that people don't see the IRS for the horrible risk it presents.
I think you're right. We spend so much of our time trying to warn people about the IRS, but sometimes I wonder if our words go unheeded.
But the IRS can be dealt with the right team and the right preparation.
Can IRSMedic be the right team for someone with an IRS problem?
Yes, but only if they see the IRS as a problem. IRSMedic, the law offices of Parent, and Wynn, LLP. Real tax attorneys for tough tax problems. We're good.
We're good.
Live on Parental Advisory, talking about high-income audits. And there's a couple groups this will affect that we started to touch on: offshore investors and also partnerships. This is going to, I think, have some impact on those types of people. High income, generally the IRS considers you high income if you are $200,000 to $399,000 per year, but it's been recommended to them that perhaps they should go after the even bigger fish because they make more money.
Well, if that's high income, then what's someone who 400,000, like extra high,
right?
extra high, XX high.
But reportable income isn't related to how wealthy you are.
Oh God, yeah, we did that demonstration on our tax brackets. We showed you exactly how your AGI has nothing to do with how wealthy you are or what kind of lifestyle you have or the cash on hand, the things you're able to do. If you do things right, you should be a low-income taxpayer, right?
Yep.
Look at that. I don't have anything. I have my little side money here. I mow grass or something. Yeah, if you're doing things right, you should be a low-income tax auditor. That's my goal. My goal, by the time I'm ready for retirement, is to be a very low-income taxpayer. So low. Just
$400 a year.
That's something I just wasn't able to structure right. So I did make $400 a year. Yeah. What?
I know.
This is so crazy and backwards when you think about it. And this is what happens when your idea is to take people's property, the property that they came into in a certain year. You're going to get bizarre things. You're going to have strange things happen. And as we said, we've been trying to make a point of, if you want to understand what the U.S. tax law is, if you want to know what the law is, all you need to do is ask yourself something. When it comes to one issue, what's the strong lobby? What's the strongest lobby? I'm going to tell you this. The law is going to favor the strongest lobby. That's just the way it is.
Right.
And so this is where we get very bizarre things happening because there's a lot of high-income people that have no lobby.
Yep.
They have no lobby whatsoever, and they get whacked again and again. And one is partnerships. There's been a recent act, the Bipartisan Budget Act of 2015. It's bipartisan, okay? Because that means good. That's focus tested as bipartisan means good. Okay, so the Good Budget Act of 2015. This was an article written by tax attorneys at Strasburger and Price LLP, and it was on one of my favorite blogs, Procedurally Taxing, and it was a really great article they wrote. And essentially, this is really crazy because there's one of the ways you can really screw a partner is using the tax code to screw up a partner and dump a tax liability onto them without kind of their knowledge by forcing distributions that they don't quite get. This was one, and attorneys are good to do it to each other. We had a client, and he made a lot of money as an attorney in New York City, and the firm had a few offices in New Jersey, and I think maybe California. Anyway, the bulk of the partners, he was a partner, but did not have a controlling interest, decided, we're going to prepay our New Jersey tax liability. So they took all the partnership money and say, we're going to prepay New Jersey. And what it was doing was our client didn't have a New Jersey obligation. So he would have to, in order to get that money that he needed to make his Connecticut taxes and his New York state taxes and his IRS taxes, he had to wait to file his refund, New Jersey refund, but he couldn't do that until October 15th of the following year.
Oh, man. Wow.
Yeah. And so we're trying to get some understanding to say, look, this guy, he's making a lot of money, but I'm saying he can't pay you a lot because it's a struggle for him to wait this time. He's intentionally being screwed with. And so when we showed that to the IRS, like, this guy's being intentionally screwed with, because they said, okay, all right, you know what, we'll cut you a deal, and we were able to get far lower.
That's really cool.
And he's a high income earner, who couldn't afford to pay the IRS because partners, you could screw with your partners by making money go places, but it's accounted as their income, but they actually don't get the cash.
Is he still their partner?
He's got a better job now. Yeah, he's like, okay. So I'm like, I'm gonna be. Yeah, So
I mean, it's a sad story that he got screwed, but the IRS worked with him and he got a better job. So yay him.
Well, he hired us, but
Yeah.
and so we were able to look, this is what's happening. And it was pretty interesting too. And they sort of they had some sympathy there.
Yeah.
And it was just a job. It's like, this is the only job that's going to pay this amount, and it's a deal with the devil. And as soon as he could find something better, he was gone.
It made me think of something that I had a thought the other day that, we are constantly sort of bashing on the IRS, but it makes me think about a lot of the IRS employees who aren't bad guys.
Yeah.
I think we should do a whole podcast about that.
Oh, there are.
IRS
there
people.
are.
There's good people there. And if you're an IRS employee, Eric, shout out to you.
Yeah.
There's some good people in the agency. It's just, it's not a great agency.
Well, you also know how to, you have to let that good person in them come forward. Mm-hmm. And there's ways you can make sure that good person doesn't come forward.
Yep.
Being confrontational and saying, I'm a lawyer and I know my rights. I'm going to record this conversation. That's one. Okay. In an audit, and I did something on this. In an audit, you have a right to record it. You have a right to record an audit, video record, I think audio record, maybe video record too. And so people want to know, well, they ask us like, well, you're going to record the audit with the IRS? It's like, I'm like, well, why the hell would I do that? Mm-hmm. Okay, because first of all, there's going to be a record of what's said. Because it's going to be a record of the dumb thing you said.
Yeah.
Okay, that I'm going to no.
You never said that.
Okay, you didn't say that. Second of all, you're creating a hostile environment. Now that revenue agent can't find in your favor because now they're like, okay, this is going to be reviewed by everybody. Mm-hmm. This is going to be a court document. There's no way in hell they're going to find favorably for you where they have a discretion. We're like, well, I can go this way or this way. But this guy's recording me. Okay, screw you. It's going to go this way because I know you're going to challenge me anyway.
Right.
So I might as well start up here. And, we'll get beaten down. So you're not going to win that. You're going to have a hard time winning that first level. And yeah, you might set yourself up great for future litigation. I hope you have that appetite for litigation. That might end up in tax court. And then, people might take it a little offense that, oh, this is a guy who records people? Mm-hmm. Oh, a weirdo. Yeah. That's kind of creepy. So yeah, you don't want to record it.
That's good to know.
There's really no reason to. If you're doing your job correctly, there's no reason to.
Exactly. Now, high-income audits, another group of people this may affect is offshore investors. Mm-hmm. We know this already. They're being creamed. I mean, they can't catch a break lately. The IRS, we know, is trying to make an example of people who haven't filed their FBARs correctly. So it's people that have done what they think they're supposed to, and they're still getting audited, and they're still getting screwed.
Right. The IRS has been looking for incoming wires. They have been looking for people who've made the so-called soft disclosure. Here's a case. This is not a client of ours. This is a story we heard from an FBAR auditor who's actually a regular auditor. Okay. They're just a regular auditor who now is in charge of administrating this part of the Bank Secrecy Act. It's not even part of the income tax. They're in charge of it. This is what they have to do. Mm-hmm. So it's not like it's not someone from the Treasury Department who's working for the bank department, investigating banks. No, it's just a regular IRS examiners who will say this. Okay, we concluded the Title 26 portion of the audit. Now we're going to move to the Title 31 portion of the audit, where we'll assess FBAR penalties, and that's where it comes from, the Bank Secrecy Act in Title 31. And so this is a story where here's a gentleman who was investing in a Swiss bank, and he didn't really know what was going on. He went to somebody who advised him of this strategy. Oh, here, move your money to offshore, where there was no discussion of tax evasion or anything. And I think he actually was a dual Swiss-U.S. citizen. He was living in the U.S., but there's a completely legitimate reason for him to have the money there. So now in 2009, when the whole offshore disclosure program came out, that the first one, there's a 20% penalty on your account value. Mm-hmm. Now, this advisor did not want his client to go through the program. The reason why, because in your program, you have to say who were the people who advised you to do this, and you have to name them. If this client, who would have been more than fine going through the program, if he knew, he wasn't. If he knew what the if he was given the whole story, he would have gone through the program. Oh my God, I was breaking the law. Sure, 20%. Yes. But the advisor says, no. You know what you need to do is we just need to amend some tax returns, file some missing FBARs, and that'll be the end of it. Okay, that's known as a soft disclosure. Mm-hmm. The advisor told him to do that because if the client went through the program, the advisor would have been the name, the IRS would have had the name, like, hey, what's going on, buddy?
Yep.
Hey, so you like advising those people on the tax evasion, huh?
And not everyone is eligible for soft disclosure.
There is no one is eligible for it. It's not a thing. It's a made-up word. People call it that. Mm-hmm. People call it a soft disclosure because they think it, or quiet, mm-hmm. because they think it is, but it's not. It's so stupid because, so let's see here. Your soft disclosure is amending old returns to include foreign income, and you're filing new FBARs. If you're the IRS, do you think you could find out people who filed amended returns to include foreign income and FBARs for the first time, and then you go through your database of like, well, are they new? Oh, wow, that's funny. We see them here on the amended returns and new FBAR list, but we don't see them on the OVDI list. That's funny. Well, you know what? Why don't we send out one of our examiners? And that's what happened to this guy.
Ah.
And so and now by this time, it's years going on, and he's in ill health, and the IRS auditor is interviewing this guy about the FRs, and he learns that, oh my God, this guy was lied to throughout the whole process by this advisor who wanted the money and didn't want this disclosure to be made. And so the examiner says, okay, this guy shouldn't be assessed the willful penalties, the willful 50% penalties on the account value. I don't think he should get anything. The examiner says, and he's telling us this story. He's like, I don't think the guy should get anything. He's clearly not even in his right mind. And he's clearly being manipulated by these other people who are telling him what to do to cover themselves and to take care of number one. So he goes, nothing. I'm going to assess this guy no penalties. He sends it up to technical services at the IRS to approve it. Like, hey guys, yeah, this guy, look, he didn't know what was going on. He was totally lied to. He paid the tax. Let's just leave it at that. Mm-hmm. And the technical services says, no, we're going to make it an example out of this guy.
Shut up.
Yeah, and they assessed him 50%. One, they went easy on him, I guess. They didn't assess him 50% penalties. They only assessed him one. Mm-hmm. So that was what they did to him. And, that examiner, told us that story, I think, just to say, like, I'm not a monster.
Yeah.
I am not a monster. That's really...
that sucks.
That's really bad. What they did. And so, that's what they're looking for. But technical services is getting their marching orders. And where are they getting their marching orders? Right? Mm-hmm. Here it is.
Yep.
It's about the money. And this is what I sort of suspected. And now they're just in the open about it.
Yeah. The fact that their IRS is able to assess, it's not just a tax, it's 50% of the account. And if it's for the past 6 years, it's insane. You can end up owing more money than you ever had.
Yeah, ever had. Far more.
Yeah.
Right. And the account doesn't even need to make money. And a lot of the things people don't even know are the types of accounts. Foreign life insurance. Mm-hmm. That's something a lot of people are like, well, no, I've always reported my foreign accounts. I don't have to go through the program. Like, yeah, but you have that foreign life insurance. What? Oh, yeah. But it's life insurance. It's not taxable. Oh yeah. Well, let's talk about how the law works. Let's talk about the strong lobby. That's the domestic life insurance. And so this is what they've done is they've gotten it both ways. They'll define a foreign life insurance policy as not a life insurance policy for tax purposes. Mm-hmm. However, they will define it as a life insurance policy for foreign excise tax purposes. That is, there's an excise tax due, like a sales tax, due quarterly, a Form 720, because it's foreign. And so you get the worst of both worlds because that's how strong the domestic life insurance lobby is.
Wow.
Yeah.
All right. So there is a chance that you'll be audited even if you're not high income. Now and then it's going to happen. You should be prepared.
I would say that if the IRS thinks you're a great target, there's a great chance you'll be audited. And your income might not have anything to do with it. But they're about getting revenue.
Mm-hmm. Yep. All right. Well, we'll wrap up right after this on Parental Advisory. The IRS takes us serious because we are serious.
We've earned our reputation, and we will protect our reputation.
The IRS knows exactly who we are.
We're full-time advocates, not part-time middlemen.
We are creative problem solvers, not dull form fillers.
We're lawyers, the others, they're not.
IRSMedic, the law offices of Parent, and Wynn, LLP, real tax attorneys for tough tax problems. And we're live on Parental Advisory. Today on Parental Advisory, we're talking about high-income audits. Thing I read in a blog by Michelle Wynn that I really sort of loved was, she said, we're not just doing an audit of random numbers on a page. We're doing an audit of your story. This is what OVDI attorneys are trained to do. I loved that. That it's not just, all right, give me your information and we'll see what we can do. It's okay, give me your story and we're going to make this situation better.
Mm-hmm. Right, because there could be, a lot of times it looks like a bad fact, but there's a really good explanation for it when you dig down and you want to make sure that. And you have to understand what looks bad to the IRS and what are they really looking for. So that is exactly what you want to do. And because you could put the numbers there, but if they don't believe your story, they're just going to come back with something. If they don't believe you have a reason for it, and if you haven't addressed the bad facts in a way, you're going to have a problem.
Yep. So audits, like we said, they're not just about money. About compliance. Now it's about money.
Now it's about money. The IRS says that the IRS claims that compliance will be borne by all, but that's not true. Only a small portion of people will be responsible for the audits. It's about the dollars, and it's officially about the dollars, which is new. I suspected it was been about the dollars for years. And you have to understand, if you are being audited, their assumption is that they can hit you with a tax bill. We just went over examples of what they can get per work hour, either $4,500 an hour or maybe only $600 an hour, but that is their objective. Something to think about is that the person who prepared your return may not be the best one to be your audit representative. If they made a sloppy mistake, they're losing some negotiation leverage, and they may want to cover up their mistake so as not to look incompetent to you. Everyone makes mistakes on returns. It's something to understand. But that's why it just might be better to get somebody fresh and new to look at your case from a fresh perspective. And also, if your person who prepared your return did something shady, they might not be so forthcoming about the lapse of ethics that they possess. And I think lastly, hiring an attorney doesn't make you look guilty. It makes you look smart, and that's somebody who can't be pushed around.
Exactly. We've had many conversations about how the IRS takes someone who has representation from an attorney more seriously. And the IRS has admitted that to people here in the firm. They prefer working with attorneys than CPAs or someone on their own.
That's right.
So it's worth it. If you're going to fight the IRS, try to fight the IRS.
There you go.
All right. Well, thanks for listening to us today on Parental Advisory. Thanks for joining Parental Advisory, hosted by Anthony Parent, produced by Claudine Gindel, that's me, engineered by Chris Chen. For more podcasts, visit our website at parentaladvisoryshow.com and like us on Facebook to submit story ideas. We'd like to thank our sponsors, IRSMedic.com, the law offices of Parent, and Wynn, LLP, real tax attorneys for tough tax problems.